Hey guys, welcome to this week's Money and Investing Show, and man, are we in for a treat today. This week we are looking at ESG investing, environment, social, corporate governance. We've got a special guest to help walk us through some very specific lenses on this. In fact, this is such a big area, it's a third of global assets under management are now under an ESG mandate. What does my guest know about it? Quite a bit. He happens to manage $7 billion with an ESG mandate in the marketplace. Plenty to take out of the show. I'm looking forward to hosting you. See you on the other side. Hey there guys, welcome to this week's Money and Investing Show. As you'll see this week, not Mitch Olorential, but I have got a special guest. Very proud and pleased to have James Harwood joining us on the Money and Investing podcast today. How are you doing, James?
Really good, thanks, Andrew.
Bit of background for our followers. We originally started working together in London, I think way back in the early 1990s. I think between here and then, we've both lost a little bit of hair, and I think we've probably gained a few kids too. I think 7 as we stand between us. So much has happened in that period of time, but great to have you on the show. And the purpose of what we're going to talk about today, obviously, it's a huge topic that's out there in the investing world, ESG. Environmental, socially aware, government type investing, definitely your bread and butter. Tell us a bit about where you sit in that space. What's your gig? What do you do?
Yeah, thanks, Andrew. Well, I'm at Russell Investments. I'm managing a number of equity funds in the ESG space. Started my foray in ESG investing started with our ETF, RARI, which is an ESG ETF listed on the ASX. And for the last 5-6 years, I've also been running a number of global low carbon funds, so low carbon investing in the global equity space. And that's been another really big theme that we've seen develop over the last few years.
So to give our followers a bit of a quantum to work on, what sort of assets under management have you got your paws on these days, buddy?
So in the ESG space, I think it's just under 3 billion Aussie dollars now, and that's kind of split fairly equally between Aussie and global equities, and still managing money as well. That's not specifically ESG strategies. That's probably the same again, and around 7 billion in total.
Sort of rolls off the tongue rather well, and testimony to your track record and performance in this industry now. I mean, you come with a great reputation, so we're grateful to have you on the show today. So let's dive in a little bit deeper and talk in the broad sense. How would, if you're talking to a lay person, maybe not somebody that you'd be dealing with at the level that you play at, but your average person that was considering investing in the stock market, how would you describe ESG investing and what it is?
Yeah, I think ESG investing is really all about where assets are invested, but in a responsible manner, where you're also looking to measure the performance of a particular fund on certain ESG characteristics. So I obviously mentioned low carbon strategies. A classic metric there is the carbon intensity of the portfolio that I'm running versus, say, a market benchmark like MSCI World, and we're looking to see, what kind of level of carbon reduction we can get in that portfolio relative to the benchmark. So that's a good way of thinking about it.
And obviously, carbon, huge thing, particularly for us here in Australia. We're obviously tied into global protocols, Kyoto, amongst other things. Yet we're also, such a substantial exporter of coal.
Yeah, look, I mean, I think it's always really important to be aware. We are a mining-heavy country. The materials sector is about 20% of the Aussie market, so that's way bigger than what it is in global markets. And I think it's about trying to strike the balance right. I definitely don't think ESG investing is all about excluding all investments from mining. It's too big a economy to ignore, and more recently we've seen just how important that that sector is to our economy. Iron ore is not necessarily a carbon intensive industry like some of the fossil fuel industries, and it's really the fossil fuel kind of area that's of most focus, I think, when it comes to Paris agreements, and we're a couple of months away from the next climate meeting in Glasgow.
It's no question about it. It's changed massively. And again, if I go back to our early days in our career, way back in London, and we'll leave the name out of the investment manager, but back then, Evergreen, I think, was one of the trusts that particular company run, which back then was embryonic in terms of environmentally aware kind of investing, and quite frankly, was quite a tricky space to operate in. It was a very marginal minority type product. Your Mungo being hemp clog wearing, marginal people that like hugging trees, or at least that's the misperception at the time. Whereas environmental investing now is front and center. It is mainstream. And it's probably been one of the strongest performing areas in markets. So not only from a conscience perspective, it's also been an incredibly profitable area for those people with skills like yourself.
Yeah, look, I think 5 years ago, and so much has changed since I've really been involved with ESG investing. Definitely 5 years ago, people regarded ESG investing as forgoing investment performance, or you invested in these strategies but expected to have lower returns. That's no longer the expectation. I think most portfolio managers are investing in companies that have good governance, so score well on the G side of ESG. That's really important to kind of drive long-term quality returns from an investment. And I think a lot of ESG strategies, it's worth being aware of some of the biases within those strategies. So I mentioned fossil fuels. A lot of ESG based investments don't have that exposure, or don't have a lot of mining exposure. Until very recently, that actually was a real tailwind to performance. But I think what we've seen more recently is some of the energy stocks bouncing back. Since probably in the last year or so, since we've started to see a different kind of market since the vaccines have been out. And certainly one thing that we talk about a lot at Russell is just how the vaccines have changed markets. And it's really all about the reopening trade. And I think that's particularly important at the moment as we're all getting vaccinated and getting close to key kind of metrics for different states to reopen.
I think you're right when you talk about the sort of biases within the corporate governance in particular has continued to move further and further to the sort of foreground of the investing landscape. With obviously there are those companies that are very, very good at managing that and demonstrating good character through their visions and values and actually living by them. And I suppose in the shadows, there are those that from a corporate governance perspective have perhaps struggled in terms of sort of staying in the white light. I'm thinking ASX specifically, maybe Crown Casinos would be an example where the level of corporate governance has been quite short of the mark as far as the market's concerned.
Yeah, I mean, look, it's been a journey for some, and there's definitely a number of bad examples of governance. Rio Tinto was with the Junction Gorge controversy, and AMP have had their own controversies as well around just diversity on boards, etc. So it really covers a lot of different areas. I think just one thing it's worth being aware of is just the amount of investor bodies that are involved with ESG now. So some of your listeners will no doubt have heard about the United Nations Principles of Responsible Investing, or the UNPRI. So that organization was established in 2009. But what we've got here in Australia is a lot of active ownership. So a lot of different groups trying to influence corporate behavior to have better ESG practices. And what we definitely know is that having these industry bodies is a really constructive way of actioning change in terms of getting companies to do the right thing. So really trying to act collectively to influence behavior. And I think we've also seen business models changing, haven't we? I know we spoke the other day about BHP and Woodside. BHP demerging its oil and gas business into to partner up with Woodside. So there's a huge amount of change that's going on as a result of some of these kind of ESG trends in the market.
I think BHP is a perfect example insofar as, from a corporate governance perspective, you've had, quite a dynasty of extremely robust corporate management on a balance sheet basis, but also in terms of the corporate leadership side of things, stepping back through probably 3 or 4 CEOs now. And if you look at the various spin-offs that BHP has engaged in over the years with S32 and BlueScope both being off its balance sheet and standalone, it's really done probably more than anyone in that mining space to keep a very lean core business, albeit a behemoth one.
Yeah, look, like you say, it's a fascinating company. BlueScope is, it's one of the shining lights of the market this year. Steel and I think I mentioned the reopening trade that's been really supportive of cyclical stocks like BlueScope. I think there's more to come though. I think yes, BHP has done this. Rio has also exited thermal coal. So thermal coal is generally regarded as it is the most dirty of all kind of energy production. So it releases the most carbon into the atmosphere. And I think these companies are going to continually change and adapt their business models for a world that's going to be lower carbon in the future. So I think expect to see a lot more change and action like we have been seeing.
It's and I guess it's a better world as a parent. When you think about what we're leaving for our kids behind, not that we want to get too morose or morbid, I think we're far too young for that conversation, but when you think of the world that we leave behind, if we're able to move the needle in the right way, environmentally particularly, that has to be a good thing. I saw a statistic the other day, talked about the growth of ESG in terms of the quantum, and it quoted 1/3 of assets under management now are being managed under a form of ESG mandate. I mean, that's just a staggering figure.
Yeah, and I think it then comes onto the conversation of greenwashing though as well, and what are all these assets doing good in the way they invest? I think we can.
Sorry to cut you off, James. What exactly? Could you just define through your lenses how you define greenwashing for our listeners?
Yeah, sure. Sorry, Andrew. Yeah, so greenwashing is basically the overstating of an investment's ESG credentials. So if an asset is suggesting, a fund is suggesting it's ESG, what is it really doing? So how can that particular manager say that it has strong ESG credentials? And I think that's where I know right at the start of our talk today, I mentioned about metrics to measure funds. I think that's really important for investors, because there is a lot of marketing material that's out there that's probably claiming a lot of funds are ESG type vehicles, but I think the reality is that's not the case. There's probably a smaller subset of funds that will deliver true ESG objectives. So I think it's a case of what are the objectives of a fund? We talk about that quite a lot at Russell. So what are we trying to achieve from this particular portfolio? And then trying to give investors clear and concise metrics so that they can see, what's the level of ESG improvement of this particular fund, or how much lower carbon is that fund versus a standard market benchmark. And I think the clear labeling of products is going to become increasingly scrutinized. It's already becoming increasingly scrutinized by regulators, and I think you can expect to see more of that. Just given how popular ESG has become, we need better education for investors ultimately.
You can understand from a sales and marketing perspective, it's a beautiful banner to sort of stand underneath. On that subject of greenwashing, and I apologize in advance for putting you on the spot, but you're a sharp man, so I'm sure you'll dispatch this one over the boundary of one bounce. In your experience, maybe over the last couple of years, what's been the single worst example that you can think of where there's been a prima facie greenwashing example where someone's just had a crack at doing nothing but putting it under the wrong banner?
Yeah, look, I've got a good example, Andrew. I always think about this whenever people talk about this subject, and it was when we launched our ETF RARI, so that was April 2015, and there was another provider that launched an ETF. So we were trying to become the first ESG ETF on the ASX.
So this ETF is called RARI.
RARI, yeah, RARI.
Is that a reflection of your predilection for fast cars, my friend?
I wish I could afford one, Andrew, but no, and it's also probably not the greenest way to get around. But yes, certainly do like the cars. But no, so basically we launched RARI April 2015. I think the month earlier there was another provider that came out with an ESG ETF. That ETF was an Australian shares ETF that was ex-tobacco and ex-controversial weapons. And by that, I mean, it doesn't invest in tobacco or controversial weapons. The reality is that we don't have any tobacco or controversial weapons stocks in the Australian share market. So it was basically an expensive tracker fund that did absolutely nothing, claimed it was an ESG-based investment, and really was misleading, I think, for investors in terms of what they were getting. So it's a real bugbear of mine that so exclusions is a big part of ESG investing. So trying to exclude the sin stocks, let's call them, the classic sin stocks that are often excluded. But I think there's often products that claim that they're excluding various industries that actually don't apply to the market they invest in. So for Australia, it's really alcohol, gambling, and fossil fuels. They're the three key kind of areas of ESG that tend to get excluded from portfolios.
Mm-hmm. On that note, and I guess a lot of investors that are particularly in direct shares versus managed products have got their watch list of or go-to list of stocks that they like to invest. And I guess the composition of companies can change over time. I mean, just looking at Woolworths and its divestment from Endeavour. Talk us a little bit through there, because I guess it takes Woolworths from being in a marginal space from an ESG perspective to something that's justifiable inclusion.
Yeah, look, Andrew, that's an incredibly topical one, actually, because in the ETF that I mentioned, RARI, we've just made Woolworths an eligible investment, and it's likely to go into the ETF at the end of the month. And that's because, as you say, they've demerged Endeavour Group. So
for the benefit of those that aren't across Endeavour, if I may, so that would include their alcohol distribution business, Dan Murphy's and the like.
That's right. So I think before the demerger, the alcohol business was around 15% of Woolworths revenues. A lot of ESG investments use a revenue threshold to determine what's a significant part of the business. So, and often that revenue threshold is 10%. So the Dan Murphy's type businesses of the old Woolworths meant that it was excluded from certain ESG strategies. Now that Endeavour is a separate listed company, Woolworths is a kind of a pure play grocer. It then becomes an eligible investment, and we might even see the same type of thing with BHP next year for certain ESG funds. I know BHP has a long history, but it will be basically out of fossil fuels this time next year. A new capital structure, and it'll be the biggest stock in our index again, because all of the UK listings are coming back to Australia. So I think that's going to be a really interesting play for 2022.
As we look ahead, for somebody that's a retail investor and perhaps they're mulling over wanting to take a greener approach to their investing, what sort of advice would you give them in terms of how do you go about building a screen? Is it just simply hitting the books and understanding the mechanics of the business, or are there other things that you can use to perhaps assist?
Yeah, look, we have this kind of conversation quite a lot with financial advisors, and I think the first thing to understand for any investor, whether you're a financial advisor or an individual, is what are your values, and what do you want out of your investments. I often point individuals to the RIA website. So this is the Responsible Investments of Australasia, so RIAA. and that's a really good independent resource that investors can look at. There's a product certification tool that you can find particular ESG based products that match your kind of ESG values, and then it also allows investors to screen for what they want to avoid. So those sin kind of industries that I mentioned, and also what characteristics that you want to have more exposure to. So it's not just about excluding. It should be about positioning for the future. So investing in companies that have got good environmental characteristics, or they're providing education or healthcare. These are the types of sectors that a lot of people are looking for more exposure to.
Well, it's a greener looking future for sure. And if the growth trajectory that we've been on over the last decade is anything to go on, how do you see the growth in the ESG space over the next sort of 5 to 10 years?
Look, I think most people would think it's for sure, it's already mainstream, but that's only going to continue. I think what we'll probably find is more metrics and ESG characteristics to help investors understand what a particular fund offers them. But without a doubt, this is what investors are expecting, or our clients are expecting, and there's a lot of pressure on asset owners to do the right thing as well. And I think I mentioned the industry bodies. There's a number of them in Australia. We have quite a powerful voice given the size of our superannuation money here, and I think a lot of initiatives have actually been led out of Australia, despite us being a relatively small country by GDP relative to other world markets. We've certainly been a much greater thought leader in this than say the United States.
It's a fascinating space, and as I say, it's obviously grown considerably. Activist investing, I've not been to too many AGMs. I don't know if you get. I guess these days they're virtual too, so it's not quite the go to the ballroom and listen to it all get rattled off. But you sort of think back in the day, you'd have a few activist investors at an AGM sort of hijacking it, and now you think that's almost certainly the majority of people in the room. That's how much of a seismic change that there's been over the last handful of years. Amazing.
Yeah, look, I think the best example there, Andrew, is ExxonMobil and Engine Number One, who are an activist investor in the US, and maybe comes to a good point that they invested in Exxon not because they wanted exposure to oil and gas. They actually wanted to change the business model of Exxon. So fairly recently, their efforts, so to say, Engine Number One is the investor I'm referring to here. They've managed to get some seats on the Exxon board, and that was, I think, with about a $50 to $100 million stake in the company. So not a big percentage of the company, but again, this is the kind of trend that we are seeing, and particularly in focus industries like the oil and gas industry. We know that has to change a lot if the world is to decarbonize. And I think there's a lot of vested interest in kind of boardrooms, and without significant change in the makeup of those boardrooms, you're not necessarily going to get the kind of speed of change that you would need. And I think to BHP's credit, I think definitely BHP has taken a lot more initiatives than certainly some of their kind of similar companies over in the US.
There you have it. Absolutely. It's great to get a look through the lenses from the rarefied atmosphere of managing 7 billion into this space. It's such a serious space, such a great growth opportunity. If we can, and as we get towards the back end of our time together, mate, one of the things that we like to do, and I apologize in advance for putting you on the spot, but again, you're a sharp man, so I'd say you dispatch these pretty easily. One of the things we like to do with our guests is a section we call rapid fire. I've got a couple of quick questions for you here, and we will get underway. So what's the best advice you think you've received personally in life or about investing?
Probably to take risks over the long term, because I think there's probably no no more time like now, given where interest rates are. So you're not going to be able to create wealth if you don't take risk. So I think trying to understand the risks you're taking, but doing so in a a considered way. That would be my kind of mantra, I guess.
Yeah, you live and breathe that. I know that for sure. Over the years, I've just seen that come to the fore. Okay, we talked a bit about carbon. Bit of a trickier question here. In terms of the garage, petrol, diesel, or hybrid? What's in your house?
Probably not the greenest at this stage. That's partly because I'm also a value investor, Andrew. So I don't think electric vehicles are really at the price point, and perhaps the technology where I'd be buying one just yet. So yeah, we've got a diesel and a petrol vehicle in our garage.
Yeah, well, you get on the pushy a fair bit, mind, don't you? And you've got your scooter as well, so you do your bit. I'll give you that. Okay, another one for you. Investment styles. It's all great what we do for a living. What do we do personally? Property, shares, and crypto. Any one of the three? All of the three? Where do you sit on those?
Well, I guess in terms of wealth creation, kind of addressing my previous comment, property is the area that I've made the most out of over my lifetime. So I think it's obviously a great investment. It's an investment that many Australians love. It's it's part of our DNA, I guess. So I think the leverage that you get from real estate investing is what helps, obviously, with that wealth creation. And really, it's all about making sure that you buy at the right price, and that's something that I love to try and find. Something that's a decent value play. I think, admittedly, it's quite difficult in this property market. I think things have gone a little bonkers just recently with interest rates being as low as they are. But I think where share markets are at, that would be where I'd rest. And frankly, I don't really understand crypto, so I wouldn't put a lot of money in something that I just don't understand.
Good call. Okay, final one, and obviously being a father, two beautiful boys, Ollie and Charlie, hope they're well. What advice, you sit them down, you're talking about the investment landscape now, so they're sort of just about to kick into probably getting close to teenage years now. What advice are you giving them in terms of the game of money and investing?
Look, probably not that exciting advice, Andrew, but I think just be disciplined. I think we've all learned over the years about the dollar cost averaging type approach to investing. So being regular with your investments. It's always very difficult to call the top or the bottom of any market, but if you keep investing regularly, that's ultimately the best way to have a kind of a long-term success in whatever you do, basically. So yeah, but just be consistent and disciplined.
Awesome. Well, on that note, my friend, it's been a fascinating insight into the world that you live in. We're certainly very grateful for you creating the time that you've carved out for us today, and there's some brilliant insights there for our audience. So on that note, I'd just like to thank James Harwood, Portfolio Manager for Russell Investments. People can find you, I'm guessing, on LinkedIn or on the Russell site if they're looking to place some dollars under your management. I'm sure your financial planning and distribution team will be able to help them.
Perfect. That's great to chat, Andrew.
Thanks very much for your time, James. Much appreciated.
There you have it, guys. Make sure you give us a review and a rating, and we'll see you on next week's show.